Welcome back, everyone. Michael here with Offshore Citizen. One of the main things that we help people with here is how to legally reduce their taxes to the lowest amount possible. And so today I'm going to discuss with you a little bit about how to utilize non-dom, typically remittance-based tax regimes in order to pay zero tax. I'm going to talk a little bit about kind of the short and long-term planning around that and why, actually, for the right people, I think it's an outrageously good deal. So let's dive in. Before we do, if you haven't already, please hit the subscribe button, hit the all notifications bell, make sure you don't miss out on any of our videos. If you'd like help with paying the lowest legal amount of tax possible, international tax optimization, forming companies, opening bank accounts, getting residencies and citizenship, structuring your business to be optimized for tax, etc., please reach out to us. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below. Or send a message to our websites, offshorecitizen.net and offshorecapitalist.com. All right, so really quick recap. What is one of these non-dom remittance-based systems? Basically, the way this works is you have certain countries, notably UK, Ireland, Malta, Cyprus, a few others, typically British common law countries, that have a separate concept of domicile and residence. In other words, you can be resident somewhere but not domiciled there. And it's a weird concept because domicile is typically not defined in statute. This means that it's not actually, there's no legal definition in the law, but it's this idea of where you belong. And they'll say that while you can have multiple residences, you can only have one domicile. So it's sort of this idea of like, where is your home? Where do you belong? And in some countries, you have a concept of domicile by choice. In some cases, there's other ways of looking at it, and you kind of have to dig into case law to understand what is domicile. But what's useful is that you can go and live in a country and be resident there and not domiciled. Okay, so that's the first really important thing. There's not a lot of countries that have this, but some of them do. And when they do, they sometimes have a special tax regime associated with it. Now, mostly I'm going to focus here on Ireland and UK because they have probably the most useful of these. There are a few other countries that do as well, and some of them are really good programs, but maybe not in the same way that this program is. Okay, so we're gonna talk about it from this context. And what do I like about this? Well, what I like is you can actually go and be resident in a country like UK and Ireland. So oftentimes you're making this trade-off from a tax standpoint. You could say, all right, I go to Georgia and I benefit from a preferential tax regime in Georgia. The reality is, like it or not, the quality of life in Georgia is simply not as good as it is, say, in UK. Okay, now, freedoms and personal, there's other factors that people might consider. There's cost of living, there's lots of other things. So somebody might prefer Georgia, for sure, right? Georgia, you could say, okay, it's wonderful. Or, Ukraine or whatever other country. But it is objectively true that there is a set of first world amenities, infrastructure, etc., that exist in certain countries that does not exist in others. And, for all the negative trade-offs, this is one of the reasons why, in spite of everything else, people continue to come from places like India and live in UK as opposed to moving from India in the same quantities and living in Georgia, even though it might be easier to do so, right? And so there's lots of advantages to that. You get a very cosmopolitan lifestyle in some place like London. Obviously, you could be in other places, Edinburgh, Dublin, et cetera, et cetera. And so, you might like that. It's also an English-speaking country. Okay, the weather sucks, it's expensive, but, to each their own, right? Bottom line is, this is something that's worth considering for people who are looking for that, right? But the problem is, normally, if you were to choose an equivalent country, right, let's just run down a list. We can compare, Ireland or UK with Canada, with Norway, with, something like Australia, etc. What's the problem? The problem is you're going to end up paying really high taxes to live there. And often you get trapped in this tax net where, for instance, you're someplace like Canada, you have an exit tax, so that's no good. UK doesn't have an exit tax, that's great. Ireland sort of doesn't have an exit tax, a little different thing. I've done some videos talking about Ireland previously. Norway has an exit tax, etc. So you could pick, you have a selection of countries that are, kind of what we would call equivalent countries, but most of them have, some big negatives on the tax front. Now, maybe it's still worth it to you, right? Maybe there's opportunities, maybe you're willing to do the lifestyle. Taxes certainly aren't everything. And so, that's perfectly fine if that's what you choose. But if you are concerned on the tax side, you have an opportunity to do something with UK and Ireland, some other places as well, but UK and Ireland specifically, for the purpose of our video. that you could get optimized. And this is taking advantage of this non-dom regime. So how does this non-dom regime work? The way that it works is it's remittance basis on foreign income, which means that so long as you don't bring that money into the country, so long as it stays outside of, in this case, Ireland and UK, and this basically means you have a foreign bank account that money is received into, you can earn that money and pay no tax on it, all right? Now, there's sometimes trade-offs if you eventually do bring it in and things like this. The purpose of this video is not to discuss those regimes so much as how to use these regimes in a bigger picture, all right? So let's imagine that you've already made some decent money. You've already built a company that's fairly successful, etc. You've got some good cash flow, and the company's maybe got some management in place. It's not just you. You're not just a sole trader or something like that. Maybe you've got a strong investment portfolio, and you say, okay, perfect. I am now going to want to move to UK. Well, you can bring a whole bunch of money in with you, and whatever money you bring in, that's fine. You can spend that. There's no tax consequences, etc. Then all of your investment income, so say the dividends from your company, maybe you've got some foreign sale of shares and things like this, can remain not remitted, and you can pay no tax on that money. Okay? So at this point, potentially, you could be zero tax. Now, if you stay there, at some point, conceivably, you're going to bring this money in, and as a result, you're going to end up being taxed on it. But you don't have to do that, right? So what is the strategy here? The strategy is you make this a few year, usually, a few years up to 7, 9 years, somewhere in that range, and there's some reasons for that, that you live in the country. Maybe your kids go to school, maybe you enjoy something of the cosmopolitan lifestyle, etc. At some point you decide that you're sick of the weather and you move someplace better. And the interesting thing is, at that stage, the money is already all in your name. Now, I want to emphasize the difference between this strategy and what will happen in a lot of other strategies. Okay, so in a lot of other strategies, what will happen is you keep the money in a foreign company. Okay, so let's again use Canada as a contrasting example. So if I'm a foreigner and I move to Canada and I have a foreign company and it's genuinely foreign, etc., I can defer money inside that company and pay no tax. Okay, perfect. Money's in a company, I pay no tax. Everything is honky-dory, same sort of idea. But note that the money is still in the company. Now, if I leave before the 5-year residency window, which isn't that long, but if I leave before then, I don't have an exit tax. Okay, so I can leave, and now I can theoretically take the money. What's the problem? The problem is when I now move to the next country, usually, not always, obviously there's exceptions, Portuguese NHR program, and a bunch of others, I will be subject to tax when I take that money from the company into my personal name. Okay, so let's use an example. Say I decide, all right, I'm going to move from Canada to France. Well, now I get hit with this big tax. I move from, Canada to Italy. I get hit with this big tax. I move from Canada to Greece. I get hit with this tax. I move from, all these different examples. I get hit with this tax. Unless I have a regime under which I can take the dividends tax-free, it's a zero tax country, I'm not going to avoid the tax when I pull the money out of the country, out of the company, sorry. By contrast, if I'm using one of these non-dom remittance-based systems, then the money is already in my name. I don't have to worry about ever taking the money out of the company. I can now move to France, I can move to Italy, I can move to Spain, I can move to wherever. It's already my money at that stage. Now, future money that I make, of course, I'll be subject to the tax consequences, but effectively I could have made, let's just call it 7 to 9, whatever the number is. There's some reasons I chose that. You can watch our video on the non-dom regime for UK. But I can go and I can be in a situation where I have all that money, I've built this wealth, and now, I don't have to worry about it so much. So this is an interesting solution, I think, for a lot of people. And so it's something that's worth considering in your situation if you're somebody who has reached that stage. It's not amazing for going and building from nothing because obviously you're going to need some money to live on. Now, I do have some close friends who have been incredibly successful who, they specifically did this where they built a large company, they moved to UK, they now are selling the company for a lot of money, and they're in a situation where it's under the non-dom regime. It's set up so that they can sell that company, not pay tax, and then they can move abroad and realize all those gains, which is pretty fantastic. So anyway, there are some cool strategies in that regard for people who are interested, and I think it's definitely worth investigating. Let me know if you have questions. Put them in the comments below. If you like the video, give it a thumbs up, share it with your friends, and I'm going to look forward to seeing you on the next video.